Have you ever really stopped to think about where money comes from? I mean, really comes from. The answer is, well, it's way simpler and honestly a lot more shocking than you probably imagine. Today, we're going to pull back the curtain on this massive system that quietly runs our entire economy. And you'll see it's all built on a pretty surprising illusion.
Okay, so let's just start with this bombshell. And I know what you're thinking. Hang on, that sounds like some wild conspiracy theory. But look, our source material is crystal clear on this. This isn't a metaphor. It's a literal description of how our financial system is designed. I mean, think about it. If every single one of us tried to pull our cash out of the bank tomorrow, the whole thing would just collapse. And why? For one simple reason. The money just isn't all there.
The magic trick behind all of this has a name: fractional reserve banking. And this is the quiet engine that's driving, pretty much all global debt and inflation. Once you really get how it works, you start to see that modern money is basically just a huge pile of promises. Promises that, honestly, can't all be kept at the same time.
All right, so to really understand how our system works today, we've got to jump in a time machine. We're going way back, long before any digital banking, to a really clever trick that some medieval goldsmiths came up with. This, right here, is where the whole illusion began. So it all started out pretty simply, right? People had all this heavy gold, and they needed somewhere safe to keep it, so they deposited it with the local goldsmith, who had these great secure vaults. In exchange, you'd get a little paper receipt. Well, pretty soon, everyone figured out it's a heck of a lot easier to trade these paper receipts than it is to lug around actual gold bars. And this is where the goldsmiths got really, really clever. They noticed something. Hardly anyone ever came back to claim their actual gold at the same time, so they started writing extra receipts. Receipts for gold they didn't actually have, and then they'd lend these out for interest. I mean, as long as everyone didn't show up at once asking for their gold back, a bank run, nobody had a clue. Just like that, money was literally being created out of thin air.
So it started out as this, profitable little side hustle for a few goldsmiths. It didn't stay a secret for long. This idea was just too powerful. It got scaled up, it got institutionalized, and it eventually became the absolute bedrock of modern banking and even government finance.
Yeah, it wasn't long before governments wanted in on the action. Take the Bank of England. It was founded way back in 1694 for one specific reason: to lend the government money that it didn't actually have, so it could go fund its wars. And guess who got stuck with the interest bill? Yep, the taxpayers. But here's the thing. A system like this is naturally super unstable. Bank runs would happen, and they'd expose the whole illusion. So what did they do? Did they stop? Nope. Governments actually doubled down. They created central banks to be the lender of last resort, basically propping up the entire fragile system.
Okay, so how does that old goldsmith's trick connect to the system we're all using today? Well, the principle is exactly the same. It's just that the scale is almost impossible to wrap your head around now.
Let's walk through a classic example. So imagine you deposit $100 into your bank account. You're probably thinking it's just sitting there, safe and sound, right?
Well, not quite. See, under the old model, the bank was required to keep maybe 10%, so $10 in reserve, but then it can turn around and loan out the other $90.
Now, let's say the person who borrowed that $90 goes out and spends it. The shop owner they paid then deposits that money into their bank. That second bank, same deal. It keeps 10%, so $9, and loans out the remaining $81.
And this just keeps going again and again, multiplying all the way through the system. Your single $100 deposit can end up creating almost $900 of new money in the economy. But here's the real kicker. All of it is debt. Every single new dollar is created as a loan that somebody has to pay back, plus interest.
But if you think that's crazy, you need to buckle up. Because the story I just told you, that's the old way of doing things. It's actually outdated. The system we have today has taken this whole thing a giant leap, and I mean a giant leap further.
That's right, 0%. Since March of 2020, the reserve requirement for banks in the United States is literally zero. Banks are not legally required to hold on to any of your deposits. Not a single penny. In theory, they can lend out every single dollar that comes in.
So this leads to maybe the most important question in all of modern finance. If banks don't need reserves anymore, what's stopping them from just creating infinite money? What's the break? What keeps this whole thing from just flying off the rails? And this is where we see this absolutely fundamental shift. The thing holding banks back today isn't how many deposits they have. It's this complex set of international rules called the Basel Framework, or capital rules. And here's the part that'll blow your mind. Banks don't wait for you to deposit money to make a loan anymore. It's the other way around. They create the loan first, literally just typing new digital money into existence on a computer screen. And it's only after that that they have to check if they have enough of their own money, their capital, to cover the risk if that loan goes bad. The whole model has been completely flipped on its head.
And look, this isn't just something happening in the US. The UK, Canada, Australia, they all run on zero or practically zero reserve requirements too. They're all relying on those Basel capital rules. Now, on the other hand, you've got major emerging economies like China and Brazil. They still use those high double-digit reserve requirements as a way to actively control lending and steer their economies.
So, what happens? What are the results when you build the entire global financial system on this one idea, that all new money is just debt with interest attached? Well, you end up with three consequences that are basically unavoidable.
First up, inflation. It's simple, right? As banks keep creating more credit, the money supply grows, and that just waters down the value of every dollar you have. Your purchasing power goes down. Second, perpetual debt. This is just math. Because money is loaned into existence with interest, there's always more debt in the system than there's money to pay it back. It's designed that way. And third, power gets concentrated. The system just naturally benefits the people who create the money and the people who own real stuff, assets, which go up in price because of all that inflation.
And listen, this isn't just some theory from a textbook. We've seen what happens when this illusion shatters in the real world, and it's devastating. Think about the Great Depression or the 2008 financial crisis. In both cases, banks had created way more credit than the real economy could actually support. When fear took over and people wanted their money back, they found out it just wasn't there. And that led to absolute catastrophe.
Okay, so after all that, the big question is, why does any of this matter to you? How does this super abstract system actually hit you in your daily life, in your financial future?
Because once you understand this system, and let's be honest, it's pretty unsettling, it gives you a totally new way to look at your own money.
So here are the three big takeaways, the three powerful shifts in how you should think. Takeaway number 1, money is not the same thing as wealth. Real wealth is in real assets, stuff that holds its value when paper promises don't. Takeaway 2, debt isn't neutral. It's not just a personal choice you make, it's the literal fuel that makes this whole economic engine run. And number 3, and this is a big one, inflation is not an accident. It's not a bug in the system, it's a design feature, a direct result of how money is created.
At the end of the day, the whole thing, the entire system, it all boils down to just one thing. The value of our money, the stability of our banks, it's not based on gold anymore. It's not even really based on how productive our economy is. The whole system rests entirely on confidence. It's just a shared belief, a collective faith that the numbers we see on our screens actually mean something.
Look, this isn't about being paranoid. It's about being aware. This system, it was never designed with your personal financial freedom as its main goal. But by understanding the rules of the game, by seeing the magician's trick for what it really is, you can start to make much smarter choices. You can start to protect yourself from how unstable it all is. The game is on, and now you know how it's played.